Hello, and welcome to Quantbeats, where we dive deep into the world of quantitative finance in a video series co-hosted by Radovan, Vojtko, and myself, Dan Hubscher. You can check out our full backgrounds on the Quantbeats website or in episode 1 of this video podcast on the Quantbeats YouTube channel, which you can get to through the Q logos in the corner of your screen. But just briefly, Rado, since 2015, is the CEO and head of research at Quantpedia and a portfolio manager who managed over 300 million euros in several quantitative funds, focused on everything from volatility trading to asset allocation strategies. And we'll be talking a little bit about that kind of thing today.
Hello, everyone.
And I'm Dan Hubscher, managing director and founder of Changing Market Strategies, and I'm your resource for all things quant. Today, we're joined by our two guests, Robert Shumaker, manager of trading firm Bifrost Quest Capital.
Hello.
And Jerome Kreuser, CEO and founder of fintech firm Risk Controller Global.
Hello, and let you know how happy I am to be here. Looking forward to a great discussion.
Great. Now, before we get to Rob and Jerome's background and the rest of today's discussion, as I'm a registered representative, I need to show you some quick disclosures that are on the screen right now. And you can contact me with any questions. We'll be giving you ways to contact me at the end of the episode. Now, on with the Quantbeats video series, where seasoned investors, aspiring quants, or anyone interested in the financial markets alike can hear Rado interview quant leaders to gain invaluable insights into complex quantitative strategies, increase knowledge of market dynamics, and a peek into the future of algorithmic trading. So to kick us off, I'm going to ask Rob, then Jerome, to give us your 2-minute introductions about what you each do, how you work together, and then Rado will take it from here.
Season's greetings. I listened to a prior episode of Quantbeats, and I noted that in the introduction, you described brilliant minds who would be participating here. And I thought about the smartest guys in the room, and of course, I'm referring to Enron. And so, hopefully, we won't wind up as Enron did, but. Anyway, I am a commodity trading advisor. I have a background in mostly quantitative equity. After business school, I joined General Motors in their research department, and we provided quantitative support to all the areas that we invested in, whether it was public, private, domestic, international. I focused mainly on equities. And after a period of years, I was told by the CEO that he wanted to build internally some quantitative strategies. And he had some familiarity with a discounted cash flow model, which was a data source called Holt Value Associates. And I combined those value factors with more momentum factors. And like many quantitative equity managers of that day, survived or failed based on how those factors performed. After that, I was at Nomura on the sell side, where we actually focused on research. When do factors fail? And again, quantitative equity research. And that was during the great financial crisis. So we kind of played the role of psychologist for many of the quantitative money managers who were performing abysmally during that time period. Anyway, the factor world became quite crowded. The half-life was shrinking for the efficacy of these factors. And I decided that applying more quant strategies in a different context would be appropriate. And that's when I met Jerome. He was lecturing on his asset bubble model. And I thought, well, this is a nice segue in my career to work with something that's fairly novel. I just found it fascinating, be able to structure assets based purely on price. And we worked together. We built this global technical asset allocation model. That is my primary focus right now. I also have some proprietary strategies on the side, but being the portfolio manager with Jerome.
Great. So foreshadowing that everything you need to know is in the price. I have a feeling we'll be talking about that a bit today, and probably a bit about bubbles too. So great. Thanks, Rob. And Jerome, why don't you give us the introduction for yourself? What are you doing? and how do you work together?
The main point to be made here is that I'm the mathematician and Rob is the guy who applies this. And I have really never worked as an applied trader, but I love the math. And this is why we met at a coffee talk in New York. And I thought, well, that would be great to have somebody not only that would be able to apply the stuff that I create, but also to get the information from him and understanding better how currently traders operate, and then sort of moved into the direction of some of the mathematics incorporating that information. And not to give you a little bit of background on the mathematics that I do, when I was going into college, first time as an undergraduate, I took out something called a Myers-Briggs test. You may know what that is. If you don't, it doesn't matter. It's really sort of to give you an idea what they think after going through this test that you would be good at doing, comparing it to the capabilities of similar people in those fields. And so when I took the test, and this reminds me of the comment Rob made about being the psychologist, probably for other reasons, but the number one was to be a psychiatrist. And I said, oh, okay, that's interesting, but really it's not what I've been doing most of my life already. And they said the second one was mathematics. And I thought, well, how do they ever go together? Well, later on, when we talk about the framework of asset liability management that we use, you'll understand that comment a little better, and that's why I make it now. So in the end, I graduated with a doctorate in mathematics of optimization, because that was the one thing I realized that I really wanted to understand well and study, et cetera, et cetera. I got the degree, PhD in optimization, a minor in theoretical math, and then also in computer science. And what I did then was to actually work within the World Bank for several years, developing various sorts of models. And then I left and I went and I spent some time in Switzerland, working around the country there and also into some associated nearby countries, and advanced various different kinds of models. In fact, if you look at the models that I've done, these are all formulated in one form or another in terms of optimization models. Basically, I've worked on central bank modeling, sovereign wealth funds, reinsurance funds. We worked for a couple of reinsurance agencies, hedge funds, Ministry of Finance. We talked about combining the Ministry of Finance in the central bank, not in any formal way, but to understand how the flow of funds is working throughout in a country concept. I also actually worked on allocating health resources while at the central bank, industry and sector expansion, country models. And one of the things that got me going really into the nonlinear, very large asset liability management models was that there was a time when the World Bank decided to give a country the choice of the currency that they were going to take a loan in, because before that, the bank just decided, okay, you're going to take the loan in this currency, that currency, whatever. But then we realized, okay, now the country has the World Bank loans as a hedging capability for the criteria of how they're doing their country modeling. And that brought me into more advanced modeling, working with Professor Wetz on optimization problems, and also developing various kinds of new hedging techniques. In the process of this, I worked with, consulted for, and did and met and worked with central banks in Colombia, Peru, India, Jordan, and even ECB. Jordan was the biggest one because I was there training people in the central bank for various types of financial management for a couple of months. I gave seminars and all over the place in Washington, D.C., Madrid, Essen, Dublin, Mumbai, Kuala Lumpur, Prague, Radovan, and Singapore, Bogota, some Henry Stewart talks, etc. And also, I worked for, well, actually several years part-time running one course at George Washington University. Actually, I took over the course that Garth McCormick was teaching before he became ill. University of Illinois, and I was a senior researcher at ETHZ in Zurich, where I did a lot of the work on the bubble stuff, along with Didier Sarnet, who you may know now has actually his own website for distributing, allocating, and running the log periodic power law singularity technique on bubbles. And then it was interesting because I was mentoring two graduate students working with Sarnet. We published a couple joint papers on the bubble technology that, if we get into today, I'll talk about in a little more detail. But the interesting thing was, at the end of one of these exams for a PhD, that one of the students I was mentoring along with Sarnet was talking, I said, there's a lot of synergy between LPPLS and what I called ECHO, for Efficient Crashes Optimizer, for bubble technology. And I said, they ought to be combined. Well, they never really will, but there are techniques I'm still drawing upon, whether or not I use the output of LPPLS, that I'm drawing upon to apply to this bubble technology that we have. Okay, I better stop. I'll get carried away here. So,
well, a lot of bubbles and crashes. So interesting things coming up. We'll get there. Rado, please take it away.
Yeah. So I would probably jump straight to the point. So I know that you guys work a lot with bubble detection and stuff like that, and especially related to global tactical asset allocation. And I was doing global tactical allocation in the past. We are running some global tactical allocation models. So I'm really interested in these topics. So tell me more about that bubble detection. So how do you detect bubble? I mean, this is probably the easier part, but I mean, what I'm the most interested in is how you detect when the bubble is going to pop. This is like probably the hardest question and hardest problem. So let's imagine that you have people around who are portfolio managers. They would like to know when there is a bubble in asset, when it starts, and especially when it ends. So, I mean, how do you do that?
Yeah, it's difficult to do in just a conversation. A few slides put up would be nice. But I think that, first of all, you have to recognize that whether it's me or LPPLS, whatever, we talked about this several times over the course of my working in Zurich with ETHC and Sarnet. And that is, the hardest thing to do is to detect the time of the bubble popping. And you're not going to really basically be able to do this with a good accuracy. You can, I think, in my opinion, you can really sort of forget about that. What you can start to think about, though, and talk about is, okay, when are things getting nervous in the market? Well, there's two ways we do that. There's one way that LPPLS does it. There's another way, a little slightly different way that we do it. But the whole point of the matter in either case, although ours is a little bit different, but I'll get to later, is that if you get what happens in LPPLS is they assume that there's an acceleration in the price. Everything is related to the price. Not that price is the only thing, but it's an important thing. And it's nice to be able to depend only on the price, because then you can do a lot of stuff and apply it to a lot of different things, not just the price of an asset. For example, as LPPLS does, they also apply it to social criteria and actually physical failure of metals, etc. So what happens is that what you're really looking for is an acceleration in the bubble price beyond exponential. So it's called super exponential. The price accelerates so fast that mathematically you can show that if it were to keep up at that pace, there would be a singularity. In other words, it just increases up to a certain point and then shoots off to infinity. Now, we measure the same thing in our technology called ECHO. However, in actuality, that rarely happens in practice, although I do have some examples where it's approximately happened in the paper, that the original paper from 2018 that I did with Sarnet. And so what you're doing is looking really for the point where things are becoming unstable. Okay, then you might say, all right, I better take a little caution and at least throttle back. Now, some people have called echo a momentum strategy. It's not really a momentum strategy, but when it sees that the price is accelerating beyond exponential, you better start being a little cautious about what you do, and maybe start throttling back about how much you put into you're putting into this asset before it crashes. Forget the termination time. I'll give you an example. I was talking to some people in, it was like December 2017 at ETH Zurich, and one of the students I was working with there said, I think we're getting to a point where we may have a crash. So I detected when I ran the echo thing, I said, okay, I noticed that because it was running every week or so for the last 6 months. And it started because in momentum case, it's accelerating, it's leveraging the asset. And by the way, this works for an up or a down movement. So it's really what it's doing, it's leveraging the asset. In other words, it's not saying, well, you put 100% in. No, you put 200% in, because whatever you do, you borrow and invest in the thing. And that's the signature that's coming out. But now when it starts accelerating very fast, it tends to throttle back. So when I ran the Bitcoin problem in December 2017, it was taking the Bitcoin down from a doubling, leveraging times 2 of the investment in Bitcoin down to 0 by the time of December. And my calculation at that time was that it would crash down to a value of 6,544, if you remember the numbers from that point in time. What happened? The timing, as I was talking through, is not good about when the crash is coming, but the crash did come. It wasn't called necessarily a crash, took a couple months. By April 6th of 2018, it had dropped to 6,636, which is a small fraction of what we had predicted. This is not fudging. It was published in Wilmot. And actually, I'd sent John Authors an email in December telling him about what I thought. And he said, oh, that's great. John was at the Financial Times at that time. And he said, that looks really great. Let's talk about it in the new year. Okay. So the thing didn't crash in what I would say, okay, a predictable time period, but it did go down to the number that it was predicted to go down to. And it's not going to always work. You have to remember that it's only going to work with an exogenous, endogenous bubble actions that are taking place in the price. Feedback, for example. Everybody's saying, oh, it's rising, let's jump in and buy some too, which again accelerates the price. So that is the sort of thing that it's going to take care of. It's not going to take care of things that are exogenous or partially exogenous. It's not going to take care of a meteorite coming out of nowhere and blowing up the Fed or something, whatever. It's something that's not embedded in the price. That's what it does.
If I can just summarize, so if I understand that, there is very hard to predict when the bubble will actually end, but it's very, very good to be cautious when the, rise in the price is more than exponential. It goes faster than expected or faster than exponential.
Yeah, you try to get to a point of instability. Okay, exactly. Things are getting a little shaky now, so anything can happen, and probably something will. But to time it, it's too difficult.
Yeah, it's too difficult. Okay, and here is the question. So I can imagine how to time the market if I had just one asset. And maybe this is the question for Robert or Jerome, if you want, you can answer also. What will happen if I have 5 assets in my portfolio or 10 assets in my portfolio? Because one thing is to try to optimize one asset against the cash. And another thing is when I have 5 assets or 10 assets in my portfolio, and all of them are experiencing bubbles and in different time, etc., etc. So how do I manage the portfolio like that? How do I change the weights of such portfolio when I have the bubbles there? So when to increase the weights, when to decrease the weights?
I think the important thing to recognize is that it isn't binary. It's not like, okay, we're in a bubble, or we're not in a bubble, or we're in a negative bubble. It's probabilistic, and therefore, at any point in time, we will recommend a weighting for an asset, for any asset. And I'll give you an example of what just happened with a very in the news asset, and that is Tesla. We had been long levered 2x Tesla up until last week on Friday. Jerome sent me the latest run, and Tesla is one of the assets that we follow. And the 2x levered weight to Tesla became 0.89. So it was unusual because most of the time, as Jerome noted, this model will follow momentum. It will tag along with momentum and even lever up. We only lever 2x for any asset. But I noted that with Jerome, and Jerome, maybe you can comment on that specific asset. Is there some super exponential growth in Tesla stock, i.e. bubble, that this model recognized?
Well, actually, I'd have to go. It's interesting that you asked that, because there's a lot of information that comes out of this process that we really haven't talked about very much. And that is what I was beginning to talk about, was the point of instability. And I would want to go back and look at the numbers. I could do that now or maybe later, whatever. But the point is, it probably reached a point of instability. If I remember the numbers, they were quite high. A point of instability, you see, the technology that I use is slightly different than LPPLS, because and they're generally looking at the acceleration, and also another factor, because as you get near a point of instability, things begin to waver a little bit. It's not just, okay, you're going up like this and then power off to infinity. No, you're going up and it's getting, okay, now you're having a trade-off between the value buyers and the volatility buyers, knowing that things are getting more volatile. Maybe I back off, maybe I stay in. So what they do is they also include that factor in the facility. We look at something perhaps similar, but not exactly, and that is, when I started doing this, I wanted to take off the dependence upon what is a bubble. I don't really care what it is anymore. All I'm doing is looking at changes that are going to happen rapidly. Okay? And that's generally a bubble. But oftentimes you say, oh, how big is a bubble? 5%, 10%, 20%. I don't know. I don't care. Okay, all I care about is there a jump going to occur in the process. In other words, I'm assuming that the price process is Brownian motion plus jumps, and also associated with that, how far away are we from the normal price? When I say normal price, I say normal price in the sense of Merton, which means that, okay, it's a long-range price, that the actual price oscillates about. Now we can talk about, okay, I don't care the bubble business. How far away are we from the price that the actual price oscillates around? This aspect is going back to Merton. So I thought, okay, that's very nice. We found out, one of the students did this, by the way, that the normal price is relatively stable. Okay. So it's not something that's very sensitive. There are other factors that are more sensitive to the detail, which benefit from the use of applying various types of machine learning and AI. Okay, you're looking at some of the data coming out of here, and some of that data includes the distance from the normal price in percentage terms, and also the probability. But the distance is important because that's a factor. Okay, starts to get too far. Okay, start to get a little nervous. Yeah. Well, So it was starting to get a little nervous because the distance from the price was getting a little bit high. So there's a lot of stuff we can get out of there yet.
Good.
Yeah.
So before we get too deep into it, there was just something that I wanted to clarify for everyone because I don't know if everyone's quite clear. We talked about this bubble detection stuff. I think you called it efficient crashes optimizer. But just to be clear, because there were a number of different references here, is that stuff actually a money management strategy? Is it a technology? Is it a methodology? What is it actually?
Well, I think that's a good point. But it's okay. First of all, it's a tool. It's a quantitative tool.
Tool.
It's a tool that can be used by itself. And it's also a tool you can integrate into the asset liability management framework. And that's what we do. We do it and we do both. That's fundamentally what it is. Bottom line, tool used in various places.
So when I have like the prices that behave plus or minus normally, like Brownian motion, and I start detecting that there is unusual movement, exponential movement in the price, which can detect the bubble. In this case, the question is, should I buy this bubble or should I avoid this bubble? I mean, as a momentum player, I want to buy this bubble because this bubble can go up for a very long time. That's what the momentum traders do. That's what the trend following traders do, etc., etc. And here is the question: if I have an investment universe and this investment universe has a lot of underlying assets, in a lot of the times, those assets, they experience the bubbles at the same time. So how to work with those bubbles and not to have the bubbly portfolio. So it means not to be over-concentrated just because there are a lot of the bubbles in one sector of the assets. So do you manage somehow this, or do you go full in because this sector seems like a great opportunity, or that's my question.
It's not a matter of are you in a bubble or not in a bubble. It's a matter of what do you do when you are in a bubble. Yeah. And that information comes out of the echo version. Now, you have to think of this as applying, really what you're doing is applying the Kelly criterion.
Mm-hmm.
And I had a post the other day on LinkedIn. One colleague, I know the fellow well, was talking about Jim Simmons and about whether his use of Black and Scholes or mean variance, because he wasn't a big mathematician. And I said, look, forget BS, forget MV. Jim Simmons was a Kelly better. To understand that better, you have to read a few things. If you know what the Kelly criterion is, it's so incredibly simple, but it's so incredibly beautiful that I don't know how one can avoid it. And that is quite simply bet more when the probability is in your favor and less when it's not. And that fundamentally is telling you that information of what to do in that respect is coming out of echo. It thinks the probability is good here, so bet more. No, it's not, bet less. All right, no. So now we're talking really about one asset now. Now we're incorporating that information also into asset liability management, but that's a different story. Kelly goes back to work that was done in Bell Labs in the 50s, developed initially by a fellow named Claude Shannon, who developed it during World War II to sort out signal from noise in communications. But then a guy realized, well, heck, I can take that and apply it to finance. And Claude Shannon did the theoretical work. And then another guy, a mathematician, Ed Thorpe, who you may know because he did very well in the real market. Okay, there's several books he wrote, like Beat the Dealer, Fortune's Formula, etc. Okay, so he got involved in it. He went to Las Vegas and he did real well. He was playing blackjack and he did great until the casinos realized, okay, he's got something up his sleeve. Now we got to either prevent him from coming into play or we shuffle the deck every time. And when they shuffle the deck, they ruin the probability for him. So we couldn't calculate the probability as well. At any rate, he ended up, as you know, going off into finance and making a lot of money. So that's really the essence of what's going on in the bubble business here. I wanted to be able to apply it at any time in a bubble or not, and to take it either individually or incorporating it into the asset liability management framework by considering it to be a transient process. In other words, a short term, if you will, a tactical allocation, if you will, on how to manage it in the short term, whereas in longer term, okay, in what we do in the portfolio, we run the pro forma portfolio, by the way, then it blends into the transient.
If I can jump here, so when we have the advantage, we should press that advantage. So, apply the Kelly. And here is the question. So how to combine this mathematical knowledge and this knowledge with the asset liability management that you mentioned before. So how do you, connect this money management and this bubble detection with the actual portfolio measure with that asset liability management?
If I could just step in for a moment here. Typically, quantitative money managers who are managing portfolios will take an alpha source and a ranking, whatever. And
yes.
in our case, that's actually the Echo efficient crashes optimizer. And then on top of that, Jerome has his own proprietary optimization process, which will put together a portfolio. And in the case of the global TAA portfolio, we put together a portfolio that is 200 long and 100 short. So it's essentially long, but I will defer to Jerome on how that optimizer functions in the portfolio construction.
So now, given that we have the bubble, I realized early on, and this is why I told you about the psychiatry business at the beginning. And it also interests me what Rob was saying about he had to act as a psychologist. Well, it's interesting, I think, about how much psychology has to come into this because of doing several different models. What the hell are we optimizing? And okay, what I realized is that a good analogy is the supposed quote. Henry Ford said later in life that he said, look, if I had asked people what they would want, they would tell me they want a faster horse. And then, okay, that's very reasonable because they don't know what's out there. They don't know what else that can be done. But the problem with is you ask what people want and they'll tell you what they know. But you have to try to give them what they need, I think. And this is what I thought about many times throughout my whole life. So it's not a matter of what they want. They may not know what's available out there, and they may not be able to articulate what they need because they don't know what's available. If you give them a smorgasbord, they can say, okay, yeah, I prefer the steak rather than the sushi. But at least then they have an ability to see the choice. So what we want to do is give them a choice. And I said, it's so hard to figure out what people really need because everybody needs something a little bit different. In fact, I was giving a talk. I put it on our website. Everybody is a little bit different. And I said, what I have to do is to be able to put together a framework that can apply to what people need, not just what people want. And the only way to do that was to build a structure that allows a lot of flexibility in what they deciding what they need and what they want. Uniqueness is a part of every person in every institution. I gave a talk in ETHZ, and it was like 2014. And the name of the talk was Risk Management in Public Institutions is Different. Everyone is different in its own way, thanks to Tolstoy. In that talk, I discussed the possibility of being able to rapidly compute a useful asset liability management framework for whatever it is that they need. And what they need is various goals to be satisfied. If you ask them what they want, they'll say, "Oh, I want the highest return with the least risk." What is that? How do you even define that? I mean, it's ridiculous. So you have to put together something about, okay, really what I want or what you need is a set of goals that make you happy, comfortable, and presumably give you essentially what they want. So that's the framework I started out building. And in order to do that, okay, you have to be able to incorporate a number of things. A lot of goals. We built a framework for Sovereign Wealth Fund of Norway that was published, by the way, and this was done in 2007 before the big crash hit. And built upon this structure, which now has been refined again, built upon this structure and presented at a conference at BISECB, World Bank Public Institution in Frankfurt in 2008. 14 years later, and this structure was built on a dynamic stochastic programming structure, which essentially means a tree structure, how uncertainty evolves in the future. Uncertainty doesn't evolve on a horsetail. Horsetail is what we call a bunch of different scenarios. This is what generally they do. Okay, you talk about Monte Carlo, you'd run them, you combine them, and you're done. But that's not the way uncertainty flows in reality. You move a little bit, and then things change. And then you move a little more, and things change. So that you end up requiring a branching tree. So I put this together for this model and put together, by the way, I can't think of a time when I've ever constrained the variance. It's always looking at conditional value at risk, constraining the downside. Or it could be actually constraining the upside. You can reverse them and do it on the upside, but usually on the downside. I had over 3 stages, 9 fundamental equations and downside risk in each node in each of the equations, resulting in 27 CVAR constraints over a period of actually running for 27 years. 14 years later, in 2022, the expected published value of the paper on Sovereign Wealth Fund of Norway in 2008 was within a fraction of a percentage point, its expected value within what the real value of the fund had in 2022. Okay, now this is one example, but what you realize is, hey, these things are pretty damn stable, and they're not bad over the long term. 14 years, the expected value is practically right on target. And it included things like multiple currencies, because this is a sovereign wealth fund. You have currencies and bonds and stocks in each of 4 different currencies. Then you have oil flows. What's the flows from all the oil in Norway? Well, they get a lot of money. They have been getting a lot of money from oil. And also they have to give some to the central bank. Well, all these factors taken into account, 1% after 14 years. Come on. So what happens is that means we have to take into account a couple of things. We have to build a flexible structure. We have to allow for multiple kinds of targets and goals. We have to consider the short term and the long term, because actually you can't do it in stages. What happens in the long term may in effect happen with tell you what you need to do today. This is the only structure I know of that can follow Warren Buffett's advice. One of Warren Buffett's advice, because he's given many, but the one says that if there's nothing to do, do nothing. That is a possible outcome today of this structure. Yeah? And I can show it. I built an example where that specifically holds, a very simple one. Okay, but it can hold. In other words, it's not like mean variance. First of all, the process isn't normal, because we allow for various extremes, fluctuations, mean variance, other theories that can be thrown in. taking offsetting interest rates and currency rates, etc., exchange rates. So that there's a lot of stuff that go in there, but the structure is incredibly solid, stable. You don't have to think about like you do in mean variance. Oh, I'm going to flip to one vertex over another if I tweak the data a little bit. No, what you do here is you go back and you tweak the uncertainty structure. And that is the real way that you tell whether or not you have a good structure in your asset liability management. Now that requires a little more work. We haven't done that, but you're running a $10 billion portfolio, for example. This is what you do. That isn't going to be a big deal now that computers have become so fast, storage is so fast. One I ran in 2007 for Norway was 300,000 variables and 200,000 constraints, CVAR constraints. And CVAR constraints are incredibly cheap because they're linear. And so you can throw these out, they don't impact the solution. I got the solution. Okay, it took several minutes, but it didn't take that long. We have to build all these pieces together. And at some point, I can talk more about them. But I want to let Rob jump in and make a few commentaries about this too.
Well, I would just note that in addition to Echo, which is an important component of the portfolio construction process, the optimizer can take any quote unquote alpha inputs. And we have done so based on some current situations, and it has been helpful. We may do another rebalance. We typically have a monthly rebalancing frequency, but we may do intra-month rebalances based on what are usually volatility changes, not necessarily regime changes, and we're doing a lot of work on that. But like Jerome said, why should we rebalance the portfolio just to incur T costs if it's telling us that we don't really need to do anything? But at other times, we will make sometimes a subjective call to do a rebalance.
Rob has come up with several indicators that I keep saying we have to integrate this in. I mean, look, we have a lot of things to do, as it turns out. But I said we have to integrate this into the process because it could impact bet size. Bet sizing is incredibly important here, by the way, and we've been refining that more and more because you get an optimum solution over the tree structure, and it's pretty stable. But what we want to do, we want to integrate a lot of these ideas that Rob has come up with, like the inflationary indicators, etc., and incorporate those into the whole process, which is not difficult to do, but just to settle on the exact way how to do it and to test it. And I can also say that there's incredible amount of flexibility in the structure that allows us, and in fact, within the bubble structure, now we have some rudimentary, I guess you would call them more brute force methods of machine learning, the structure, what the output comes out to be. But there's several indicators that are totally obvious candidates for incorporating more in terms of the AI and ML process going into it. So I expect, on the average now, we're running this thing for like seven years.
I remember that you mentioned Jim Simmons. I saw the interview with Jim Simmons. I mean, he's not between us, unfortunately, maybe a year or 2 years ago. And he discussed there that, I mean, it's not so important or not hard to find like alphas, but where the math gets really complicated is how you combine those maths together and how you run optimization, all those alphas together. So, I mean, this is when the math can be like more complicated. What is your take on that? I would say that you probably agree with that. So it's not so hard like to detect the bubble or to find like the edge and find the opportunity. I mean, what is like more complicated is to when you have like more those opportunities, how to combine them into the proper portfolio. I mean, tilt it and has like good asset liability structure. So am I right?
Yep.
Okay. That was
You're right on.
Never mind the probabilities, Rob. I think the quant just gave us a binary answer.
I mean, this is like the main takeaway that I have from what we discussed today, or what I took away from our discussion. Because as I was listening to you, this is probably the main takeaway. It's very hard to detect when the bubble will pop. It's easier to detect when the bubble starts, and when the bubble starts, we should take our risk when our probability tells us that we have a high probability to actually earn something. So we should use the Kelly criteria. But here is the catch. I mean, when we have the multiple instances like that, the hard thing is to actually optimize them into the portfolio, because then it starts to be more complicated. So.
Well, it's in a way it's more complex, but it's actually not as hard as it sounds, because what we do is we break it up into 5 separate modules, each one independent of the other. And I mean, the one is the model expression, critical. Okay. Try to write this in Python in general form, you're dead. Okay. Well, you may come back and do it, whatever, but you're not going to, you have to incorporate a structure that allows you to do these things easily. And this is what we did. When I constructed the model for Norway, it did this in a few months. It incorporated all those factors. And now all we have to do is, okay, enter the factors, the prices, and then you have to make some decisions, a few decisions, not many, you default them, on calculating the dynamic stochastic differential equations for all the processes put together, and then take those and generate your uncertainty structure, and which can be a scenario structure completely. Now you have complete flexibility of how to do it. 1 period, 2 period, 10 periods, however you want. And then put that into the model structure, which is totally independent of all the different, how many assets, liabilities, derivatives, whatever you put in, how many, independent of how many CVAR constraints or goals or whatever. They asked me in LinkedIn the other week about what is the code for a CVAR constraint look like. I showed them. It was about a dozen lines. And that code of a dozen lines handles any uncertainty structure, any set of assets, any set of liabilities, any set of cash flows, you name it. It's there. So all you have to do is define at the outset. So we can add them, subtract them. You can even put multiple CVAR constraints on the same distribution and control it. And one of the things that we haven't done here, but one of the things you could do after getting a solution, look at presuming you think that the uncertainty structure is reasonable, you can go back and shape the distributions.
Thanks, Jerome. I think that's a good point to end on, those asset and liability flows. I was kind of thinking about how to wrap that into Rado's takeaway, the main point on the bubbles. And I guess listening to you guys tactically, what I took from this in terms of bubble detection is that I think you're saying it's not about avoiding a bubble, it's about knowing what to do when you're in it. Knowing what to do when you're in a bubble. And that's where the tactical asset allocations come in to get in and out of different things. But more strategically, you made a point about this ALM, asset liability management, which I take to be that everyone has different flows of assets and liabilities, like you were just talking about there. Everyone's got different goals. So it's the asset liability management structure that gives you different strokes for different folks, I think was the point, rather than a monolithic strategy. And sometimes that's where the tactical asset allocation magic comes in, which may result in active trading, or like you said, if there's nothing to be done, then do nothing.
When I was at the World Bank, they had run a pension fund I was talking to when you could need to make a change to some of the equations. So they wrote, I won't tell you who they wrote to, might embarrass them. They wanted to charge $300,000 to change one equation. Come on. What the hell did you write it in? I mean, that's ridiculous. I could go in and add and subtract an equation, and well, of course, you have to test it, but I can do it in an hour. But it's just a matter of testing it.
Rob, any parting bits of wisdom before I wrap this up?
Viewers to be aware that we have a website. A lot of these ideas are discussed there, and please check it out. It's riskcontroller.com.
Good. And I can help people with some more guidance there. So thanks, Rado. Thanks, Jerome. Thanks, Rob. That's great for today. So if any of you want to meet Rob, if anyone wants to meet Jerome, if anybody wants to meet Rado from Quantpedia, or if you want to join us as a guest, or even if you're just interested to otherwise support the channel, contact me, Dan Hubscher. The details are right here on the screen. And just note that any questions regarding investment offerings will be deferred to an email follow-up for compliance purposes, as these videos are not intended to be about investment offerings. So if you like this video, please do come back for our next interview with a Quant Manager guest. You might also want to watch the other videos on the Quantbeats channel at Quant-Beats on YouTube. So don't forget to like, comment, and subscribe to Quantbeats on YouTube. And again, you can get there via those Q logos in the corners of your screen. Or finally, you can visit our websites and YouTube channels for more, shown right here. So thanks everyone for joining. And as always, have a quant day.
Bye, everybody.
Bye.